Hey, Archie, my AI stock is now about 75% of my total portfolio. Should I be concerned?
Well, Rob, let's look at some options. I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to the Last Paycheck Podcast, brought to you by Hoxton Planning and Management. We're your hosts, CFP professionals Archie Hoxton and Rob Hoxton. And today we have an interesting topic for you. At the recording of this episode, one day ago, yesterday, there was a lot that happened in the market, and there was some news around AI, and a good handful of technology stocks took a terrible hit, like a massive, massive one-day hit. And it kind of occurred to us that, hey, we haven't talked about what to do if you have a concentrated stock position. If your portfolio, if a big part of it is just in one stock. And this is a reasonably common problem to have, and often it's a good problem to have. It means that maybe you made a really great return on a stock. Maybe you bought Apple, 20 years ago or something.
Or NVIDIA, you could have, 7 or 8 years ago, you could have invested $10,000 and you'd have $1 million or some unbelievable number now. So
yeah, or Tesla. I mean, there's a lot of companies that has resulted in this happening to people. And it raises a question, well, what do I do now? And so we've got some ideas for how to handle that.
yeah, I mean, as things go, and this is not popular advice oftentimes, but we would argue that it's good advice, and that is as the portfolio begins to sort of become overweight to one position or one or two positions, as the case may be, you need to be keeping an eye on the risk. And the problem is that if you own one of these companies that it just skyrockets in price, you're sort of enjoying the sense of well-being, the wealth effect that's created emotionally when that happens, and the sort of the mental negotiation that goes on in a person's mind that makes them think that this is going to continue forever, this sort of recency effect, that it's gone up, it's going to keep going up, and it may, until it doesn't. And then you're stuck with a situation where you may see a substantial loss of wealth because you're concentrated in one position. So,
right.
And so much comes into play with the whole behavioral finance area with this. So I love this topic. It's difficult to convince people to diversify when this is happening.
Yeah. Another reaction that may take place is actually fear, where you're someone who's more keenly aware of the risk and the volatility, and you feel, hey, I got lucky. This is great. But now I have this highly volatile, my portfolio is significantly more volatile than it would be if it were diversified. And that poses a problem. And maybe now you're like, wow, I could have a more comfortable retirement than I expected. But with a single position, one stock, that calls that idea into question. But then on the flip side, if you want to do something about it, you also have a tax problem. Let's say now if it's in an IRA, the question is really simple. It's sell this and diversify. There's no tax issue that comes with it. Or a Roth IRA, that would apply too.
Yeah, wouldn't it be great if it was a Roth IRA?
Yeah,
then you held it in. Oh my goodness.
And there's stories about there's some famous investor that had
Peter Thiel,
I think it was Peter Thiel. He has the largest Roth IRA in the world. He made some amazing investment in a company that, anyway,
in privately held companies like private equity investments, right?
Something like that. Yeah. And so that's a very different set of circumstances, but this is more for people who have this in a brokerage account and now have a giant capital gain. So the choice is diversify and pay the tax, or hold on to it and retain the risk. So the first option that people see if they decide it is time to diversify is just to sell it. And so in this case, if you've held it for more than a year, you're going to pay capital gains taxes.
Mm-hmm. Which are more favorable than, say, ordinary income or short-term cap gains rates, right?
Right. Depending on your tax bracket and depending on the size of the position, you could be in the top long-term capital gains bracket. If you were going to do that, one strategy you could take would be sell this over multiple tax years.
Right.
Use the fact that you get a clean slate every year and spread the capital gains out and slowly wind it down over time. That's one approach. You're still going to be paying some taxes, but you're going to be diversifying and sort of reaping the rewards of this lucky set of circumstances that you came across.
Yeah.
So that's sort of option one. I think a lot of people find that to be less attractive. Most people don't like to pay taxes.
Yeah, I mean, if your objective is to avoid paying taxes and reduce risk, there are things that you can do. I do want to, Archie, before we move on to the next strategy, I do want to kind of focus back on the interpersonal piece of this. So much of what a good financial planner does is help to sort of moderate this back and forth that couples will have oftentimes when it comes to investing. And in all the years that we've been doing it, it's really rare that you have a married couple, it doesn't matter whether they're married, long-term committed relationship where both of them are aggressive risk takers.
Yeah.
You'll often see both of them be risk averse, but more often than not, you'll have one person who is more comfortable with investment risk and one who's less comfortable with an investment risk. And so oftentimes when we sit with a client and we say, hey, look, you are really top heavy in one position. And if something bad were to happen, let's say China were to invade Taiwan and you're investing 60% of your portfolio in a chip company, that's going to be really bad for that stock price.
Right.
So why don't you as a couple consider diversifying a bit so that you can lock in this newfound lifestyle that you have because this one company went up so much.
Yeah.
And I can only imagine, because the conversation is the risk taker is negotiating with the non-risk taker at the table, and they're like, no, we're going to be great and we don't want to pay taxes. The non-risk taker acquiesces, and then that thing happens. And now that risk taker is like getting the cold shoulder big time at home, right? It's really chilly at home. And that non-risk taking partner is like, holy cow, I told you we should do this. Our advisor told us we should do this. And now look what you've done. Anyway, interpersonal piece of that, but it's an important thing.
Yeah. Yeah. That's a good point.
So
there's always an interpersonal element to these financial decisions.
So is there a way to make both the non-risk taker and the risk taker happy and not pay taxes?
There are ways. Yeah. I mean, there are multiple ways to essentially, so there's selling, and then we'll get into some other options that, can mitigate the risk of or the taxes with selling. But there's also options that involve not selling and still mitigating risk. And that is, the first one is what's called an exchange fund, where basically you take your shares and you go to a company that offers this. And what they're doing is they're basically creating an exchange traded fund with investors who have concentrated risk. And so they're building out.
So instead of putting cash into the fund, you're contributing securities.
Right.
And then you have an interest in the overall total combined fund.
And so exactly.
Okay.
And the way they do this is they have lots of people out there who have concentrated stock positions. This guy's got Apple. this guy's got Amazon, this guy's got Walmart, this guy's got Nvidia and Tesla and so on. And they say, okay, you give us the shares that you want to diversify out of. We'll put it in the fund so that everybody gets a diversified fund, right? And in exchange, you get the share of the fund. So you get to be diversified without having to sell the position and realize the capital gains. This is a great option for people who, again, don't want anything to do with the taxes. Maybe have looked at other options and they just don't sound good.
I think you have to be a sophisticated investor, an accredited or a qualified investor in order to be able to do this. So you have to have certain income levels or net worth. So it's not available to everyone. But if you have a stock that's really run up in price, you're probably going to fall into that category and be able to do it.
Yeah.
Yeah.
Yeah, that's a good point. Another one that I would say you may be able to do without being, an accredited investor, but you should tread very, very cautiously and seek professional advice around this, is doing some sort of hedging strategy. Right off the top of the head, the first option that most people think of is options contracts, using put options or some sort of collar or spread of some kind essentially you're protecting the downside. You're keeping the stock, you're paying premiums for the option contract. So you're capping up your upside a little bit, but you're protecting your downside. I don't know that we need to get into a whole lot of detail on this particular strategy because it's something that, a do-it-yourself investor should not wander into it. It's something that professionals should provide.
What you're basically building is something where if the price of the stock takes a hit and goes down more than some predetermined percentage, maybe more than 10%, then the value of the options contract that you have goes up in value. The stock still went down in value, but the options contract that you own goes up in value. So on a net basis, it's cushioned the sort of the downside, and they can be structured in any number of ways. You'll participate in some of the risk, but not all of it.
Yeah. Options and any kind of derivative are extremely complex, and you should, again, this is something that options also contain have a whole different risk profile to stocks. If you don't know what you're doing, if you're not a professional, you can end up taking substantially more risk than you were in the first place.
Yeah,
so
that's great advice. In fact, here at Hoxton Planning and Management, we've been doing financial planning and investment management for more than 3 decades, and we hire specialists to build these strategies. We do not do these ourselves.
Yeah, it takes a very specialized skill set.
Don't be a weekend warrior and do this stuff.
Yeah. It's so risky. So let's talk about a couple other tax strategies. So those are really the exchange fund and the, using some sort of hedging strategy. Those are about managing risk and also sort of secondarily about managing taxes. These other options are really tax focused. And so I'd say the first one we should go into is, and this applies if you're someone who likes to donate money to charity. It is, let's say you donate to your local church or to the American Red Cross or wherever, and you're used to kind of just donating out of your cash. It may behoove you to start donating shares of your concentrated stock position and taking the cash that you would have donated and investing that in a diversified portfolio.
And that's assuming that those are highly appreciated. If you inherited a big position and you're not, there hasn't been a lot of appreciation yet, that may not be the right way to do it. But if it's highly appreciated, that's a really great opportunity.
Yeah, definitely. I mean, and to that point, you also don't really ever want to donate stocks that you have a loss on.
Yeah.
You should only donate appreciated shares, because then you're not paying the capital gains taxes charity's also not paying the capital gains taxes. They can sell it, or you can donate to a donor advised fund, and then you can retain the control and donate however you want. But donating and swapping for cash donations for stock donations is a really simple way to start winding down that position if you like to give. Gosh, we're running out of time, but there's a couple other key points. The first would be tax loss harvesting. We've talked about this before. If you are going through and harvesting losses as they arise in your portfolio, potentially other parts, more diversified parts of your portfolio, and then as that happens, sell off some of your appreciated stock so that those losses offset the gain.
And there's no tax cost that way.
Right.
Yeah.
Right. Another way to do it is using like a direct indexing strategy where you own the individual components of an index. So the 500 stocks in the S&P 500, there's usually more loss harvesting opportunities when you do that than, say, owning a handful of exchange traded funds or mutual funds. All that to say, you're winding down the position using losses from other parts of your portfolio.
You can also just hold on to a position. If you're not worried about the volatility or the risk, you can hold on to the position and just die with it.
And you leave it to your heirs.
Your heirs get to step up in basis potentially, not always, but potentially when you pass away, or when you and your spouse pass away, and then they get to have a tax basis that's as of your death or an alternate date, like 6 months later. But that's one way to wipe out the potential for capital gains tax.
Yeah. So concentrated stock, it's in many ways it can be a blessing. It's kind of like if you were to have won the lottery. It's found money. You did well making that investment.
More money, more problems, though.
But yeah, it invites a whole new set of problems: risk, taxes. So hopefully, one or several or a combination of these strategies could help you if you're looking to wind down a position like that and save money and diversify.
If you find yourself in this position, you want a little help with it, reach out, make a comment.
Yeah.
Reach out to us on the numbers on the screen, emails on the screen as well. So we're happy to lend a hand.
Yeah, absolutely. Yeah, like I said, leave a comment. Remember to like and subscribe, and hit the bell for notifications, and share with your family and friends. And as always, we'll look forward to seeing you next time.
You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.